So congratulations, you just became a homeowner. A few weeks later, you receive some mail, and one of them is your property tax bill. You're wondering, don't I get enough bills already? What is this property tax bill? So today, we're going to help break it down for you and explain to you everything that you need to know about this property tax. Hi, this is Heather Lynn with Keller Williams Realty. Welcome to my channel. Here in my channel, we talk about everything real estate related and how to improve your home for a top dollar sale. So if you find that information useful, please hit subscribe to my channel and punch that notification bell. So let's get into this exciting topic of property taxes. What are property taxes? Property taxes are taxes you pay on a property, which includes homes, apartment buildings, commercial buildings, and a piece of land. And the property taxes are based off the property's assessed market value. Usually that value is the first year you bought the home, what you pay for. And every year after that, the increase is capped at 2% due to the wonderful Proposition 13 that we have passed. So when you purchase a home, your property tax bill will be coming to you annually. They are split into 2 installments. One is due in the springtime, usually around April 10th, and one is due in the winter time. Usually the deadline is around December 10th. It's very important that you don't miss the April 10th deadline and the December 10th deadline, because the county assessor's office will assess a 10% penalty to your property tax bill if those deadlines were missed. Believe me, I made that mistake once. I missed my property tax bill just by one day, and I was hit with a 10% penalty. So if you have to set an alarm on your phone, on your calendar, do it. Don't miss the property tax bill deadline. You can also pay your property tax on the impound account. And what are impound accounts? Impound accounts are basically your mortgage payments that also include your property tax and your home insurance into a monthly installment. And instead of you going onto the county's website and paying your property tax, your mortgage company will pay your property tax bills for you through the impound accounts that are charged to you every month. So you might consider doing that if you are not someone, if you don't want to keep up with all the deadlines and all the bills. An impound account is a good idea because it's automatic, it's out of mind, out of sight every month, and your tax bills will be paid along with your mortgage payments and your home insurance. How much are the property taxes? So here in the Bay Area, 5 counties, they are usually 1.1% to 1.2% of your assessed value annually. So if, for example, if you purchase a home of $1 million this year, you should be expecting your annual property tax bill to be around $11,000 to $12,000. And remember, that amount is split into 2 payments, one in the springtime and one in the winter time. So you can pay them either in 2 installments or as in a monthly installment through your impound accounts. What are property taxes used for? Well, we live in a community, we have public roads, we have public utilities, such as the sewer underneath our house, underneath the streets. We have parks, we have fire department, we have hospitals, we have basic infrastructures that will make our community nice and friendly. So those infrastructures are paid for by our annual property taxes. So by all means, use the roads, use the parks, and you might have heard about, if you have young children at home, I'm sure during the pandemic, you guys have been taking a lot of advantage of going to the parks. Here we have a beautiful Magical Bridge Park in Redwood City, and all those facilities are mostly paid for by our property taxes. So how are property taxes assessed? They are Some of the factors that determine the assessment of property taxes are the size of the property, the size of the lot, the age of the home, whether it's a corner lot, a pie lot, and the amenities that sits on your lot. The other thing that could change the property taxes is if you undergo major home renovation or expansion, that could trigger a reassessment event. So those are the determining factors on how the base value of your property taxes is assessed. How often are property taxes raised? As I mentioned earlier, because of Proposition 13, the reassessed value cannot be more than 2% annually. So the most the county could raise your property taxes by 2% every year, thanks to Proposition 13. Unless you have major renovation expansion went on to your home, unless the home there's a change of ownership, the reassessment should be capped at 2% annually, the most. If you have just recently bought a home, you might have received another tax bill called supplemental tax. Supplemental tax is basically the additional secure tax that are assessed due to the change of ownership or a new construction. Most supplemental tax bills are mailed out within 9 months after the change of ownership. So for example, you bought a home this year at $1.5 million, but the previous owner have owned the home for 20 years. So the last assessed value was $700,000. You bought the home for $1.5 million. So the delta of $800,000 will be reassessed in the form of supplemental tax bill. So that's how, and that's usually a one-time only. You usually receive it within the first year of your ownership. And once you get it out of the way, the home should be reassessed at the correct value when you bought it. So now we have covered a lot about property taxes. I hope you have a better understanding. If you are curious about Proposition 19 and how that affects property taxes, check out this video right here to learn more about Proposition 19. And I will see you at our next video. Bye now.